You know, one of the good things about P42 being a team is that we each have our own things we can contribute into writing what we like to think are high quality scripts. With that said, this video is very much in my neck of the woods, so if you hate it, that's my fault, and you'll probably like the others. With that said, let's get to the two most overlooked factors in why people misjudge the stock market. And these are short-term judgments based on small data sets and results-based analysis. And this is true of the market in general, companies, fund managers, individuals, and every shade in between. To explain the problems with both, a quick analogy. Imagine two golfers. Mr. Hedge and Mr. Buffett are playing a 4-day tournament. We see them play one hole. Mr. Hedge hits his driver as well as he possibly can, riskily going right at the water. His shot barely makes it onto dry land, but he's left with a tricky shot over a bunker. Meanwhile, Mr. Buffett plays a safe 3-iron into the middle of a fairway. Mr. Buffett hits his next shot to a very close 5 feet. Meanwhile, Mr. Hedge hits his pitch shot, and it looks like it may roll well past the hole, but it hits the flagstick and drops into the hole for an eagle. A delighted Mr. Hedge believes he's played that brilliantly. Mr. Buffett congratulates Mr. Hedge before tapping in his birdie putt. Now, if I said to you you had to bet your life savings on one player finishing ahead of the other in the tournament, who would you be betting on? I'm assuming everyone would pick Mr. Buffett, even though the data would tell you that Mr. Hedge in the short term has outperformed Mr. Buffett. Well, the reason we'd all bet on Mr. Buffett is twofold. One, if Mr. Hedge played that hole the same way 100 times, he's going to have a worse average score than Mr. Buffett did. His very risky play happened to have paid off, but not in a way where it's likely to repeatedly work. Sometimes he's going to hit the ball in the water, sometimes his pitch is going to roll off the other end of the green, etc, etc. This is an issue of results-based analysis. A bad method can happen to yield a good result a few times. It can also be true that a good method can yield a poor result. All choices made, oddly enough, before the result. You might make a good choice that most of the time will work, but an unlikely chain of events can cause it to fail. And this is a common problem not only in the market, but in many other fields such as both sports and esports analysis. Onlookers often mock good choices because they didn't work out in this instance, whereas most instances they would. The converse is also true, with terrible decisions that lucked out being praised. Now, the cause of results-based analysis is that real life only happens once. A well thought out decision that evaluates all possible outcomes can simply be unlucky in reality. That doesn't mean the decision was bad, merely the outcome. If you were playing a hand of poker and you knew 90% of the time you had the better hand, you'd bet. Just because this is one of the 10% of hands where your opponent's cards are actually better, doesn't mean your decision was wrong. Nor does it mean the next time you get into the same position, a bet would be wrong, because 90% of the time you're going to win. Going back to Mr. Buffett versus Mr. Hedge, the other reason we'd all pick Mr. Buffett to win is that even though Mr. Hedge won this hole, we think over a 4-day tournament, Mr. Buffett will do better. This highlights the danger of judging on a very small data set. The data objectively tells us that Mr. Hedge is better, but we know the full context, and so we understand that Mr. Buffett will be better over the long term. Now, overreacting to short-term information is a Wall Street specialty. For example, it's famously claimed that Cristiano Ronaldo disgustedly set aside a Coke bottle during a press interview, and this caused a fall in the Coca-Cola share price. Leaving aside that it probably isn't the reason the price dropped, in the short term, this drop caused many people to react, selling shares and declaring doom. Now, was there any good reason to believe that Cristiano Ronaldo setting aside a Coke bottle should be wiping billions off the valuation of the business of Coca-Cola? No, it was not massively less valuable in the space of a few seconds. But if you look at things on the wrong scale, you get the wrong impression. If you look at an incident like that on a 1-day chart, it can look awful. Now, if you zoom out to a 10-year chart, you'll notice you can't see it anymore. So in the same way that you wouldn't overreact to Mr. Hedge's lucky eagle, you shouldn't overreact to short-term price changes in the stock market. Mr. Buffett the golfer will have far more long-term success than Mr. Hedge, for the same reason that Mr. Buffett the investor does. A long-term, stable, disciplined style of investment that is very, very reliable, as opposed to the massively volatile and risky style offered by Mr. Hedge. So how can you tell these things apart? Well, for one, be very wary of those promising the world. There are very few financial miracles and an inexhaustible supply of financial scams. But some hedge funds and managers make a fortune, you say in your comically high-pitched voice. Well, firstly, they make a fortune for themselves via their exorbitant fees, not for their clients. The phrase, "where are all the clients' yachts?" springs to mind. Secondly, that's kind of like saying you can flip a coin 5 times and have it land heads every time. If you flip a coin 10 times and it lands heads every time, you can retire and buy the Carolina Panthers. In reality, good. Hedge funds probably flip the coin 15 times and win 10 times. But it's the way they lose the 5 times that's the really clever bit. See, hedge funds are always heavily leveraged. So for every client dollar they'll invest, they'll borrow a large amount more. Let's say a further 9. That means if the price goes up, the client makes more money. Wow, we're geniuses, but would also lose a huge amount in the event of the price falling. It just so happens the hedge funds won't actually ride their bets full to the end. No, they'll sell when all the client's money is gone so that they don't go into debt. Just so happens the client is the only one who loses huge, because the hedge fund will sell the stock as soon as the client's portion of the money used to buy those stocks runs out. So the client can lose everything, but don't worry, the hedge fund will survive. And the good news is you'll always find another rich sucker who will buy into the hype. Now, people love to highlight those who flip the coin the best and ask them what their amazing strategy was, but nobody ever interviews the losers, the people who played the same game and lost everything. Same strategies, same philosophies, different gambles, different outcomes. Frankly, I would rather play poker than invest in a hedge fund, but then again, I'd rather just invest well myself than do either. With that said, hopefully you learned a little bit of something from this, a little philosophical takeaway if you will. Back to regularly scheduled programming with the other videos. We hope to see you in those. Thanks very much for listening and take care.